Listen carefully. If you've been watching silver lately, you've seen something that makes no sense on the surface. Price smashes in the paper market, while physical demand refuses to die. Headlines say, "Rally over," charts flash red, commentators laugh. And yet, premiums stay stubborn, inventory narratives don't resolve, and every dip gets bought somewhere else in the world. That contradiction is the entire story. Because what we're living through is not a normal bull market. It's a stress test of a pricing system that was designed for a different era. A system where paper can create infinite supply, until the real world demands delivery. Welcome back to Money and Empires. Today, we are going to map the mechanism behind the current silver conflict. Why sudden sell-offs keep happening, why the floor keeps reappearing, and why the next leg, if it triggers, won't look like a gentle climb. It will look like a repricing event. Now, quick disclaimer. This is not financial advice. This is analysis and education. Silver is volatile. Futures are leverage. And narratives can move faster than facts. So we'll focus on structure, how the machine works. Because when you understand the machine, you stop panicking at the noise. Here's the core thesis. The global silver market is splitting into two realities. Reality one is the Western price screen, a highly leveraged paper market where silver is traded like a number. Reality two is the Eastern use case, the physical market where silver is treated like an industrial necessity and strategic input. When those two realities drift apart, the spread becomes the signal. The spread becomes the truth that marketing can't hide. And that's why the psychological warfare is so intense. Because if you can't win the physical fight, you try to win the confidence fight. You try to exhaust people emotionally until they give up, not because the thesis is dead, because attention is expensive and patience is rare. So today, we are going to break this story into 5 forces, 5 pressure points, so you can see the full battlefield. Force 1, industrial dominance. The world's biggest manufacturing base is also the world's biggest silver consumer. Force 2, premium divergence. Physical prices and paper prices don't always agree, and when the gap won't close, something is jammed. Force 3, the fear bid. In unstable macro environments, precious metals gain a second engine, protection demand. Force 4, the leverage trap. Margin rules can turn holding into forced selling, even when fundamentals improve. Force 5, narrative coordination. When big institutions want liquidity, they manufacture reasons for you to provide it. Put those together and you get a market that behaves like a spring being compressed. You can push it down temporarily, but each push increases stored energy, and eventually the release becomes violent. Let S start with the big misunderstanding that keeps trapping people. They think silver is purely a trade, like a meme stock, like a retail campaign. But silver is not just sentiment, it's infrastructure, it's electricity, it's conductors, solder, contacts, medical equipment, and the industrial backbone of electrification. Silver isn't rare because it's shiny. Silver is rare because modern systems consume it and don't easily recover it. And that leads us to the first takeover dynamic. The industrial buyer does not behave like a speculator. A speculator buys because price might rise. An industrial buyer buys because the factory must keep running. One is optional. The other is mandatory. So when the paper price gets hit at 2 a.m. with a sudden waterfall candle, you're watching a game played on a screen. But somewhere else, another region, another time zone, someone is asking a different question. Can I get the metal at scale reliably right now? If the answer starts to wobble, then the price you see becomes less important than the availability you don't see. That is why we're going to spend part 2 on the industrial choke points and the premium signal, because that S the heartbeat monitor. It tells you whether the system is healthy or whether it's pretending to be healthy. And when we come back in part 3, we'll add the second engine, macro fear, how inflation risk, energy volatility, and geopolitical uncertainty can create a hard floor under silver that paper sellers can't easily break. Then in part 4, we'll talk about the dirty mechanics, margin increases, forced liquidation, and why a price drop can be engineered even when the underlying situation gets tighter. And in part 5, we'll build the tactical map, what levels, what signals, and what outcomes matter if the market reaches a tipping point. Because one thing is clear, if this was easy, it would already be over. The very fact that it keeps turning into a fight tells you it's not a normal market. Let's get into the first major pressure point, the industrial chokehold and the premium alarm. To understand silver's hidden power, you have to stop thinking like a trader and start thinking like a supply chain manager. Silver is a small market compared to equities, bonds, even oil. That small size is exactly what makes it dangerous when demand becomes non-negotiable. You don't need the whole world to panic. You just need a few giant buyers to decide we can T-risk being short. Now, industrial demand is not new, but what's changing is concentration. A huge portion of global manufacturing, especially in electrification and solar supply chains, sits in one hemisphere. And when manufacturing is concentrated, the metal flow becomes strategic. It becomes policy adjacent. Let's talk about solar for a second. Solar panels require silver-based conductive materials and key components. Even when manufacturers try to thrift silver usage, the scale of production can overwhelm the thrift. So the solar story matters not because it's trendy, it matters because it's recurring, structural demand. And if the largest manufacturing base also controls a large portion of panel production and downstream electronics assembly, then it controls a major slice of silver consumption. Here's the key. Industrial demand does not leave when price falls. Sometimes it increases, because a price dip is simply a discount on a required input. That alone can create a buy the dip floor. But the real alarm is when physical premiums persist between regions. So let's define the premium signal in plain language. If silver is truly one global commodity with free flow, then a big price gap between two major hubs should be arbitraged away quickly. Buy where it's cheap, ship it, sell where it's expensive, spread collapses. That's how normal markets behave. But what if the spread doesn't collapse? What if it stays wide? What if it widens? Then one of three things is happening. 1, shipping and logistics constraints are blocking flow. 2, regulatory or policy barriers are slowing export-import. 3, the cheap supply is not truly available in size because the market is more levered on paper than it is stocked in metal. This is where the story gets uncomfortable because it forces the question, is the paper market a price discovery mechanism or a price suppression mechanism? Now, we're not going to make claims we can't prove, but we can describe the structure. In leverage markets, a price can be pushed around by paper volume far larger than the physical inventory. That's not conspiracy. That's how leverage works. Futures and derivatives can represent many multiples of underlying supply. Most of the time, that's fine, because not everyone demands delivery at once. The system relies on most participants settling in cash or rolling positions. But when physical demand tightens and confidence drops, people start caring about the real price, the price that secures metal, not exposure. That is why premiums matter. Premiums are the real-world vote, and if you see consistent premiums in some regions, especially industrial hubs, that suggest physical demand is stronger than the paper screen implies. Now imagine the incentive this creates. If one hub consistently pays more for physical metal and another hub prints a lower paper price, then every artificial paper smash creates a bigger incentive to source metal, if sourcing is possible. So paper price drops can paradoxically accelerate physical drain. It becomes a clearance sale if the shelves still have anything left. And this is where the takeover concept comes from. Because the West is structurally comfortable trading paper claims, the East is structurally comfortable accumulating real inputs for production. One side plays financial games, the other side plays industrial survival. When those philosophies collide in a small market like silver, you can get a weird pattern, repeated smashes that don't lead to long-term breakdowns. The price dips, then finds bids, over and over. That pattern drives people crazy because they expect a clean trend. But this isn't a clean trend market, it's a tug-of-war market. So the premium alarm isn't just an interesting statistic, it's the smoke detector. It tells you where the real stress is, not in the headlines, but in the ability to source and deliver. And once you understand that, you understand why the next force, macro fear, matters so much. Because silver has two personalities: industrial metal, where demand can be mandatory, and monetary metal, where demand can surge during instability. When both engines ignite at the same time, you don't get a smooth move, you get a snap. So in part 3, we're going to talk about the fear bid, how macro conditions can create an invisible floor, why dips keep getting bought, and why paper sellers can get trapped if volatility rises while physical demand remains sticky. Let's zoom out. Markets don't move on logic alone, they move on pressure. And pressure comes from uncertainty, inflation risk, energy volatility, political risk, supply chain shocks, anything that makes the future feel less stable. When instability rises, capital looks for exits. Sometimes that exit is cash. But if confidence in cash weakens, the exit becomes real assets, things you can't print. This is where silver becomes dangerous for shorts. Because in unstable periods, metals can attract buyers who do not care about short-term price action. They care about insurance. That's the fear bid. And the fear bid has a special trait. It creates a floor. Not a perfect floor. Nothing is perfect in markets. But a recurring support zone where demand shows up. So think about what happens when paper sellers try to smash the price. In a normal calm environment, a smash can cause a cascade. Stops get hit, leverage unwinds, and the move feeds on itself. But when the fear bid is active, dips trigger buyers. Not momentum buyers, protective buyers, not gamblers, insurers. And that changes everything. Because now a smash becomes a transfer. Paper sellers push price down, real buyers quietly absorb supply, Paper sellers lose control of the float. That's why volatility can increase. The market becomes a battlefield between forced sellers and patient accumulators. Now, why does macro fear connect so tightly with silver specifically? 2 reasons. Reason 1, energy and inflation dynamics. Silver mining is energy intensive. Higher energy costs can push production costs up, reduce marginal supply, and discourage new output. That can tighten physical markets over time. Reason 2, monetary psychology. In inflationary or debt-stressed environments, confidence can wobble. And when confidence wobbles, people start valuing assets without counterparty risk more highly. Again, not advice, just behavior. And this is where the market becomes a trap for anyone relying on it should be down. Because in fear environments, should doesn't matter. Flow matters. If enough capital wants metal exposure, then paper dips don't stay dips. This is also why you'll often see V-shaped recoveries after aggressive sell-offs. It's like trying to hold a beach ball underwater. You can push it down, but the moment pressure eases, it snaps back. So the real question becomes, how do institutions keep control when the fear bid is building? That takes us to the next force, mechanics. If you can't win the market with fundamentals, you try to win it with rules. If you can't stop physical demand, you try to shake out leveraged positions. You try to force selling, so price prints lower, even if reality hasn't improved for the shorts. And the most efficient weapon for that is margin. In part 4, we'll break down the leverage trap, how margin works, why a margin hike can create artificial sell pressure, and why price action during margin events can be more about liquidation than true supply-demand. If you want to understand why silver can drop hard for no reason, you need to understand one word, leverage. In futures markets, you can control a large amount of silver with a relatively small deposit. That's the entire attraction and the entire danger. When you're leveraged, you don't just need to be right. You need to be right and survive the volatility. Now, exchanges have a tool that can instantly change survival odds, margin requirements. When margin requirements rise, the cost of holding the same position rises. If you don't add cash, you get liquidated. Not because your thesis is wrong, because you can't meet the new rule, that liquidation is forced selling. Forced selling pushes price down. Price down triggers more margin stress. More stress triggers more liquidation. That's how a waterfall happens, even when the fundamental story hasn't changed. This is not unique to silver, but silver is especially sensitive because it's a smaller market and can be more volatile. So leverage events can print dramatic candles. Now, why would margins rise during a period that doesn't look like chaos? Sometimes it's legitimate risk control. If volatility increases or the exchange fears instability, margins can rise. But markets are also political ecosystems. Exchanges serve participants, and the largest participants have influence, directly or indirectly, because they are the liquidity backbone. So regardless of motive, the effect is the same. Margin hikes punish the most leveraged longs first, and that creates a predictable pattern. A sudden explanation appears after the drop. See? Silver is weak. But the real driver was mechanical. Leveraged positions were forced to unwind. Now, here's the part most people miss. Margin drama is a paper market weapon. It doesn't change the ounces in your hand. It changes who survives the paper game. That's why you can see a bizarre situation. Price drops on the screen, while physical demand and premiums stay firm. One world is liquidating leverage. The other world is accumulating metal. This is also why you will see thin liquidity attacks, odd-hour sell-offs that look like someone dumped a truckload. In thin markets, it doesn't take much to move price. And if the goal is to trigger stops or stress margin, thin hours are perfect. Again, this is not proof of anything sinister on its own. It's simply how microstructure works. Thin markets move easier. Now combine this with the premium signal and the fear bid. You get a perfect storm. 1, a margin hike increases forced selling. 2, forced selling pushes paper price down. 3, physical buyers view the dip as a discount. 4, premium spreads widen, showing physical demand isn't fading. 5, the dip gets bought, creating whiplash volatility. That whiplash is what breaks weak hands. And that's the psychological goal, not to prove the thesis wrong, just to exhaust people into quitting. But the story doesn't end with mechanics. Because mechanics alone don't create headlines, narratives do. So in part 5, we're going to expose the final force, narrative coordination. How bearish notes and media timing can create liquidity events, and what signals to watch when the market opens and volatility spikes. Here is a rule of markets that will save you years of pain. When large players need liquidity, they manufacture stories that encourage you to provide it. That's it. That's the game. If a major institution wants to accumulate without bidding price up, it helps them if retail is scared into selling. If they want to cover short exposure, it helps them if panic creates a temporary dip. If they want volatility to shake out leverage, it helps them if the crowd believes the rally is over. So you'll often see bearish narratives appear at suspiciously convenient times, right after a drop, during thin liquidity periods, around key psychological levels when positioning is stretched and the market is vulnerable. Again, not claiming a conspiracy, just describing incentives. Now, this is where you need a framework. Don't trade headlines, trade structure. Structure is what we've built across this entire video. Industrial demand concentration, persistent physical premiums, macro fear bid, margin leverage mechanics, liquidity-driven narratives. When those align, you get an environment where paper price can be temporarily pushed, but the long-term pressure builds underneath. So what should you watch, conceptually, during the next major open? Watch for divergence. Divergence is when the paper screen says weak, but the real-world signals say tight. Examples of divergence. Paper price dips while physical premiums remain elevated, paper sell-off while demand indicators stay firm, price smashes that instantly rebound, a widening gap between different regional physical markets. If you see that kind of divergence consistently, it suggests the market is not breaking, it's being shaken. Now let's talk endgame, not as a price target fantasy, but as a structural outcome. In extreme stress, paper markets often move towards settlement preference, meaning, here's cash, don't ask for metal. That's what a system does when delivery pressure rises and inventory is scarce or politically sensitive. It seeks to reduce delivery stress, and that creates the most important philosophical choice in precious metals. Do you want exposure, or do you want control? Exposure is paper, control is possession. Paper can be convenient, but paper is a claim, and claims behave differently when systems are stressed. This is not me telling you what to do, it's a description of risk types. So here's the conclusion. In one sentence, this market is not about predicting next week's candle. It's about understanding whether the pricing system is losing authority, if physical premiums persist, if industrial demand remains mandatory, if macro fear stays elevated, and if leverage keeps getting shaken out without killing the bid, then the tension builds toward repricing. And repricing doesn't look like a gentle move. It looks like a sudden air pocket upward, where sellers vanish and the market jumps levels. That's why the noise is so loud. That's why the commentary is so emotional. That's why every dip is treated like a verdict. Because if the crowd stays calm, the machine loses power. So stay focused on structure. Watch the spread, not the sentiment. Watch divergence, not drama. And remember, volatility is not always weakness. In stressed markets, volatility is often the sound of a system trying to maintain control. If you want more breakdowns like this, where we follow the mechanics behind the headlines, subscribe to Money and Empires. Because in the next phase, the market won't reward the loudest voice. It will reward the clearest mind. And whatever happens next, one truth remains. Paper can set a number, but metal sets the limit.